All right, Nigeria's central bank governor, Godwin Emefiele, has announced the Apex Bank is planning to reduce the volume of 500 naira and 1,000 naira notes in circulation over time. Governor made this known in his briefing to the media at the Monetary Policy Committee held today. He was responding to questions about the ease of counterfeiting 1,000 naira notes and if there are plans to reduce the volume. Central bank governor also said the bank will no longer wait till the earlier proposed December 15th date to unveil the new naira notes. It will be unveiled tomorrow at 10 a.m. in the morning. All right. Joining us now to discuss the CBN's MPC decision, we have Chinwe Egwim, Chief Economist at Coronation Merchant Bank. We've also got Joshua Odebisi, who's a Sub-Saharan African banking analyst with Vetiva Capital Management. Damilola Akimbami, Senior Manager, Clients and Industries at Deloitte, and Philip Isiaka, who's a publisher, Business AM. Welcome to our panel. Thank you all for joining us. So I guess, Chinwe, let's start with you. Chinwe, what did you make of the decision? What was your forecast? Did you think they were going to hold? Because I guess analysts were divided. It was either to hold or to hike.
Thanks, Rotus. Okay, so the rate hike of 100 basis points is or was in line with our expectation, given that inflation remains elevated, even though we have seen 3 consecutive month-on-month declines in the headline figure from about 1.82%, which was recorded in July. And then we saw it dip to 1.24% in the October's release. Now, select central banks across the globe, you have the Federal Open Market Committee, the ECB, the Bank of England, Bank of Ghana, Central Bank of Egypt, among others, are still tightening in response to high inflation. And foreign portfolio investors continue to adopt a wait-and-see approach, partly driven by the yield versus inflation trend in the domestic market. So the rate hike was surely in line with our expectation.
Great stuff. Joshua, what about your expectations? What did you make of the decision today?
Well, it was in line with what we were expecting. Hike was always on the table because we knew that year-on-year inflation was going to continue to rise, even though there have been subsequent, or rather previous hikes beforehand. But we had the feeling that those weren't going to be enough to get us to the point where the MPC would be satisfied that, okay, we're sort of at the right level to manage inflation. And I'm not even sure if they're there yet.
Damilola, is inflation the name of the game here? Is that the driving force as well as what you expected with this decision?
Well, yes, inflation remains the driving force because bear in mind that price stability is any monetary authority's main objective. And the CBN governor was very apt about that, and even from the decision that they decided to go with. And bear in mind, like everyone has said, we've seen that deceleration in the pace of increase. So month on month in September and October has declined. So that to an extent should give you an idea of whether indeed we are beginning to see that trend being sustained in inflation. And the CBN basically is trying to be proactive, because bear in mind that, we're entering that season and that month where there's going to be an increase in money supply. One, obviously from the elections with campaign funds being released, and also because of the end of year festivities, Christmas and what have you. So we expect to see an increase in money supply. So you could say that the CBN is being proactive and aggressive, bearing in mind that it knows that there's going to be an increase in money supply by increasing the MPR by 100%. So, by 100 basis points, 1%. So definitely, inflation is the name of the game right now. And all the other monetary authorities are doing that. Kenya is going to have its own monetary policy committee meeting tomorrow. And the consensus view is that they most likely also would increase interest rates. So that's the name of the game, inflation.
All right, thank you so much for that. Philip Isiaka, what are your thoughts on what the decision that was made?
This was always expected, because inflation has been eating deep on this economy, and going by what has been happening globally, inflation is a major issue, for most central banks, and you didn't expect that this central bank was going to be different from what's going on, especially because we have a peculiar situation in Nigeria. Food, if you look at the component of inflation, the food aspect of it is still high, and the fact that we have challenges regarding security and farmers not going to the farms, to really produce food. food. Key thing is that you have to look at production as a matter of fact. Production is key. If production is not going well and you have more people demanding goods and services, inflation is going to be something that the central bank was going to tackle, and we should expect more of this to happen.
Okay, so I guess my question now, Chinwe, let me come back to you. Is it enough? Is monetary policy enough to deal with what we're seeing? Because now this is 500 basis points now since May, in cumulatively, but at least year on year continues to climb. So is monetary, for the whole panel, is monetary policy enough to deal with this rising inflation that we're seeing, Chinwe?
Thanks for that question. So I would say that in my view, monetary policy alone is not sufficient. Now, inflation in Nigeria tilts more towards cost push or supply side versus the demand pull inflation, right? A hand-in-glove approach between monetary and fiscal is likely to provide sustainable solutions. Now, there are challenges that cannot be tackled using a lopsided approach. Factors such as structural issues that impact the cost of doing business. You have logistical challenges associated with moving goods from place to place, global supply chain disruptions that we've seen throughout this year. And what my co-panelists did mention, the security and even flooding that's going on in select states, which are known to be the food baskets of the nation. So no, in my view, monetary policy alone is not sufficient. And that is not a signature to Nigeria, or just, it's not a signature to Nigeria. So yes, a hand-in-glove approach with monetary and fiscal is required.
Joshua, I saw you nodding your head. You agree? It's not enough to deal with what we're seeing as far as inflation is concerned.
Yeah, I think that's very much a given, that monetary policy, at least the CBN is doing its part. So you can't say that they're not playing a role in trying to curb inflation. But like Chinwe said, the truth is that you need fiscal policy to also tackle the supply shocks. And in this case, it's really down to a whole host of things, like she mentioned, transportation, security, flooding. All of these things are very much infrastructural, and so I think it's more of a failure of capital expenditure over the last 7-8 years to not address these issues to a point where we don't have the same problems that we've had for the last 20-30 years. But unfortunately, those haven't been addressed, and so the CBN can only do what they're meant to do. This is how they're supposed to act. But if the government, on the other hand, is not doing what they're supposed to do, then inflation will continue to skyrocket.
Dami, I want to get your thoughts in there as well, as whether or not these tools are enough to deal with this rising cost of goods and services that we're seeing here.
I agree with everyone. What you need is a cocktail of policies: fiscal policy, monetary policy, even what's the investment policy of the government. Because bear in mind that investment factor has the multiplier effect. So if there's an increase in your investment, that obviously would have a positive impact on output. So you can't just address monetary policy or use monetary policy alone to address inflation. And bear in mind that it's also timing, because if you're doing monetary policy now and then maybe subsequently you factor in fiscal policy, no, everything has to be done concurrently so that it gives you that right impact on the variable you are trying to target. So your fiscal policy, your monetary policy, bear in mind that the government is borrowing from the CBN has increased. So if you look at monetary policy is tightening, but monetary conditions are still accommodative. So you need to find and ensure that you are using the right mix of policies at the right time and even at the right quantum. All these definitely would factor into the implementation and the impact on the economy. So definitely monetary policy alone would not solve Nigeria's inflation problem, or even one policy alone would not necessarily address whatever challenge we are trying to address for Nigeria.
All right, Mr. Philip, unless...
I agree with what everyone
so we're unified here, okay.
Yes, we agree.
Okay.
The key thing is that the central bank will always be tackling one aspect of... It's an economy. So the economy is both fiscal and monetary. So if the CBN is tackling what's going on the money supply side, you expect that the fiscal side should be doing something that will help the CBN both policies to come into force and then help inflation. But I think the key thing is that it still boils down to production, you know. And if you look at production, you'll be looking at likely the fiscal side. You know, what are the fiscal authorities doing, you know, to ensure that production is ramped up. You know, look at all the different problems that we have in the economy and see how fiscal policy can be used to correct some of those issues. And I think that there has been a failing in that direction, and we've talked about this for so long, since this government came into being. The production side. All right, I want to ask about borrowing costs. Chinwe, let me come back to you. For the average Nigerian, again, 500 basis points cumulatively now since May or so. What's the impact now we're seeing on folks with loans, businesses, and so on and so forth?
Well, you know, the increase in the MPR could result in increased borrowing costs, or should, but it is worth highlighting that this has been priced in by financial institutions on the back of forecasts and projections that have been out there. Now, for the average Nigerian, consumption patterns could be affected as select businesses pass on the hike in prices driven by increased borrowing costs on their consumers.
Thanks for that. Are we unified on that, Joshua, as far as the impact on borrowing costs for consumers and businesses?
Well, yeah, to a large extent, but just from the bank's perspective, I think that we've obviously seen pretty significant increase in yield on assets over the last quarter. Definitely we'll see another one this quarter as well. But at the same time, on the flip side, you have the increase in their cost of funding as well. But the truth is that for the average Nigerian, I mean, the access to lending is already pretty limited. So obviously this is just going to keep that limit or maybe increase it a little bit, just due to the fact that the average Nigerian already finds it very expensive and very difficult, prohibitively expensive to access loans, at least from the traditional institutions. And all the smaller institutions who are lending to consumers are not pricing in anywhere near MPR. It's way higher than that. So I think that definitely the businesses will feel it, all the bigger institutions will feel it. But again, like Chinwe said, it's probably been priced in already.
Dami, your thoughts on borrowing costs for the average Nigerian?
Yes, definitely. We expect lending costs to increase. I think on the average right now, it's at least about 22%. But what is interesting to note is like the more difficult it is to access funds and raise funds for production and for manufacturing, that would affect output levels. That means the average manufacturer would not be able to access enough funds to be able to whether bring in its raw materials or do what needs to be done. So that would affect output levels, and that feeds into also the supply chain disruptions, the shortages and whatnot, and then also indirectly and directly into inflation. So almost becomes a vicious cycle. In one way, on one leg, you are trying to address inflation by increasing interest rates, but bear in mind that also you are restricting credit to the real sector, which needs it to be able to produce output. And if output is constrained, you are growing at a significantly lower rate, and then also it would feed into inflation down the line.
I feel like you've been talking production, so I'm guessing where you're going with this, as far as borrowing costs.
Yes, you expect that the banks generally will pass this on, you know, build this into the lending costs, you know, and then. For me, it's about SMEs in particular, you know, because access to funding has been a major challenge. Not just access in terms of the ability to have their books prepared in such a way that banks can look at them, but also the fact that interest rate is quite high for them. It's been high for a very long time, and then if you have this situation, then you're likely to see the banks put that on. And once they put that on, you know, because you have quite a large number of SMEs, you know, that have been suffering for quite a long time, then production in that sector is going to be affected. And this is what we should be seeing in the next, maybe this term, let's put it that way.
Joshua, let me come to you. The IMF, I think it was Article 4, their most recent review of Nigerian economy expressed support for increased cash reserve ratio, suggesting that they are in favor of more tightening. What's your read? I think with now, we'll put the numbers up again, but that's 2.5%, I think, from 27.5. With CRR where it is now, how are the banks going to be dealing with that?
Well, I mean, it's quite interesting that the Monetary Policy Committee decided to just leave it at 32.5.
Yeah.
I think what we've seen historically is the fact that for a lot of banks that this is not necessarily strictly the case, especially due to the fact that the CBN is still going on with its finding of the banks for not meeting the minimum LDR requirement.
Yeah.
So when you factor that in, you can imagine that the CRR is a fair bit higher. But obviously, all this just comes down to the fact that the IMF wants a tightened policy environment. And, they're all for financial prudence. They're all for cutting costs and things like that. So it follows in line. And I'm sure that they would have probably even wanted this official CRR to go a bit higher. But overall, I think that where it is currently is fine. But like I said, the actual CRR, where you look at from bank to bank on a case-by-case basis, you would see that it's probably a bit higher.
Damilola, how do you see things as far as the cash reserve ratio for the banks?
I think, the effective rate is significantly higher than the 32.5% official rate. And like what my last panelist just said, the IMF definitely, at least in its Article 4 review and statements, it's in support of a tightening stance. And when I was talking about the difference between having a tightening monetary policy stance and monetary conditions are accommodative, as long as there's still that disconnect, it still gives room for inflationary risk. And that is why the IMF is proposing that we need to tighten further, we need to increase interest rates further. So definitely the banks are going to be affected. The ones that have a huge position in fixed income securities at least would benefit from that, because we expect to see, at least as from, let's say, tomorrow, that treasury bill rates should start to increase further in line with this increase in the monetary policy rate. The equities market, definitely because of the inverse relationship, and we know that this has been bearish for a while now, especially with the tightening stance, that will continue to take the hit. So I think for banks, this what they're experiencing right now, the tightening in liquidity, they have to be more creative right now, because what is available for them to lend and to trade with has been reduced, and is significantly more than the 32.5% that is the official CRR rate.
Thanks, Dami. Philip, what do you think about the CRR?
This is in line with a global policy, really. The IMF is interested in making sure that liquidity isn't just free, in such a way that inflation, I guess it's in line with the global concern about inflation that has been going around all over the world, and then the IMF advising the CBN supporting the tightening, it's just in that direction to ensure that liquidity is not allowed to feed the inflation situation that is currently affecting the entire world.
Great stuff. I want to take a quick break. Let's go over those numbers again, if we can put that up, as far as the metrics around the monetary policy rate that's been put forward by the central bank. So there again, we'll go to break really shortly, but again, with our panel, we've been discussing these numbers on the screen now. 16.5% from 15.5%. I think May, we jumped to 13, right? From 11.5 in May, and then 14% in July, and then 15.5 September, and then here we are at 16.5 in November. Asymmetric corridor unchanged, plus 100, minus 700 basis points around that figure, and then 32.5%. The cash reserve ratio we just talked about, then the liquidity ratio at 30%. I suspect that's where Damilola is talking about the effective CRR. Put those forward. So we'll be right back with our panelists. We're going to talk about, after the break, the IMF advising the central bank to end intervention funds. What do our panelists think about that? It's the Global Business Report here on Arise News. Special discussion post-MPC. Do stay tuned. Welcome back to the Global Business Report here on Arise News. We still have our special panel looking at the decision to hike the monetary policy rate, the benchmark interest rate here in Nigeria, to 16.5%. Chinwe Egwim, Chief Economist at Coronation Merchant Bank, is with us, as is Damilola Akinfemi, Senior Manager, Clients and Industries, Deloitte, Joshua Odebisi, Sub-Saharan African Banking Analyst with Vetiva Capital Management, and Philip Isaka, who's a publisher at Business AM. So we left things off with the IMF saying that they enjoy the tightening that they're seeing. But now I want to talk about intervention funds. Joshua, the IMF also saying that CBN should halt to stop its intervention funds, I guess because of perhaps the inflationary impact. What do you make of that side of the coin?
Well, actually, I think it's a bit simpler than that. It's just down to the fact that a central bank is not really meant to get involved in that kind of policy. You know, the central bank's entire remit or purview is controlling the currency, controlling the valuation, controlling inflation. Those are the only things that the central bank and the central bank governor are supposed to do. When you start getting involved with giving loans to, no matter how important that may be, but when you start getting involved in that, you're sort of reaching way beyond the purview of the central bank. And that is just a massive concern to the IMF, because then the central bank is no longer seen as being impartial, but almost like another arm of the federal government, you know, enacting policy, basically. And so that, I think, is really the biggest concern for them. But then you now come down to the fact that a lot of money came out of those intervention funds and went into, you know, a few different sectors. Now, the viability of those sectors, or even the ability of them to even pay back those loans, it has been called into question. And so we know that a lot of money has gone out. We're not entirely sure how much of it will come back, or if they even expect any of it to come back. And all of those things have a massive impact on not only our perception, but also the financial situation within the country, and why we're seeing what we're seeing today with regards to inflation as well.
Thanks, Joshua. Dami, what do you make of the advice on the intervention funds and halting them?
I mean, if you look at the numbers that the CBN governor rolled out during his during the meeting, the total is about, let's say, 2 trillion naira in terms of total intervention funds that have been released. That is insignificant compared to the total nominal GDP of the country, which is roughly about 170 trillion naira. If you even look at the total money supply in the system, which is roughly about 50 trillion naira. So 2 trillion, is just a drop in the bucket. I think the focus should be more about addressing the issues that these sectors are facing. So one, accessibility to credit. More importantly, the infrastructure deficit. Nigeria has a wide infrastructure deficit that is estimated to be about maybe $100 billion over a 10-year span. So that needs to be addressed. Investing in the power sector, addressing the exchange rate issues, because we're talking about intervention funds, yes. If you continue, even if these funds, whether they are increased, for instance, now, but you do not address those issues, the manufacturers can't access Forex to bring in their goods or what have you, or there's epileptic power supply, or if you even scrap it as the IMF is proposing, and you do not address the fundamental issues, but these sectors are still going to be challenged and constrained. So I think the focus should be more about addressing the challenges these sectors meet, so that we can see these sectors start to yield and produce output, which would have a positive impact on overall economic growth and development.
All right, Phil, what's your take on the intervention funds?
I guess, again, it's still the inflation issue that the IMF is looking at, because all these intervention funds that we're talking about, are just creation of money, So you've created money, you pump the money into the economy, and then you're talking inflation, you keep seeing inflation rise, month on month, and then but there's also the other peculiarities about Nigeria, about the economy and how the economy has been managed in the last 7.5 years or so, where the fiscal side has been completely absent. So I think it took some boldness on the part of the CBN to step in, because when they saw failure on the part of the fiscal side, they had to do something, and that's why they did what they did, but whether it's the right thing to do, you can leave that for some other day to talk about that. But the key thing is that I don't think, given the fiscal, what's called the fiscal laxity that we've seen all through the last 7.5 years, you would say that the CBN should stop now, but what you should be asking is that, how was the intervention, is this the right intervention, or these intervention funds, are they appropriately channeled, are they yielding what they were meant to yield in terms of results, So we're looking at how to make sure that they serve the purpose for which they were introduced or they were put in place, and then just sorting out those things that we see that are wrong with it. But as far as the intervention is concerned, and as far as the fiscal side is still weak and still not doing much, you shouldn't say that they should stop. This is not the time to stop. They should be better directed and maybe more appropriately put into the right places in the economy.
Thank you for that. All right, I want to ask you, Joshua, I'll come back to you. This post-MPC press conference, the central bank governor not only said that the new the redesigned Naira notes would be unveiled tomorrow, 10 a.m. He also said that, I guess, the 500 Naira and 1,000 Naira notes, the volume of those will be reduced in order to impact inflation. Initially, we were expecting the Naira redesigns to be released December the 15th, but now, surprised everybody's pushed that forward now. So what as far as the unveiling, but so what do you make of that? Particularly that reduction in volume of the 500 Naira notes and 1,000 Naira notes, and then what impact that will have on inflation?
Well, I think when this was first announced, I hypothesized that the only way that it would have a significant impact on inflation is if you reduce the actual supply of the notes in the economy. So for maybe every 10 bundles you get in, you release one bundle. So you just physically reduce the number of notes out in the system, and that will have a material impact on inflation just by virtue of reduced money supply within the system. And I think that that's a good idea. As for releasing it earlier and coming forward with it, I think that's obviously a positive, but overall, definitely the tactic has to be to reduce the actual amount of money being printed, to also discourage people from then taking that money and putting it back where they got the old notes from.
Right. Tami, what do you make of it?
Well, from our point of view, again, let's look at the numbers. I mentioned that total money supply, broad money supply, M3, is about 50 trillion naira. Cash in circulation, which is actually what the CBN is trying to address, reining that in, is 1, 2, 3 trillion naira in total. So, reducing the supply of these high denominated currency notes, if at all, one definitely will impact positively on electronic transactions, because then you would see people are going to be forced to use more of online transactions and things like that. And bear in mind that there is a cashless policy that is at play, not nationwide, but that would help to further boost and drive that policy. And again, you would find out that a lot of the average Nigerian may be forced to now carry larger volumes of lower denominated currency notes. From our own point of view, if you look at the definition of inflation, theoretically, it's supposed to be an increase in the general price level. Is the value of the currency notes, these new notes, is it going to change? No, 200 naira is still going to be worth 200 naira. 500, 1,000 is still going to be worth the same thing. So, and the level of money in circulation, 2-3 trillion as a percentage of 50, again, it's the quantum is not that much. So I think from our own point of view, this reducing the volume of these high notes would definitely be favorable for electronic transactions. So you're going to see that pick up in your POS, in your online and things, NEFT and things like that.
All right, thank you. Phil, what do you make of it?
The central bank was alarmed, by the amount of money you had outside the banking system, and then this redesign of the notes was so to bring them back in. And then to really to have a firm control of it, because when you have money outside the banking system, the central bank practically has little control over what's out there. So they've seen what has come in. I believe that they've seen what has come in with the announcement, and they are making a good move to try to now control. The control simply means that what's going to go back, because it's people's money. The money coming in is still going to be their money. But the money back into the system, because you could have a change of new notes can come in, and people will still take their money and leave the banking system and still trade like they are. It's an economy that is a cash economy. No matter how much we have tried to change that, So this is a right move, to ensure that what's available to individual, you and I, and the general business public, is that you have the number of notes out there reduced. To help the inflationary situation.
Fantastic. All right, we're going to give everybody a minute each, because I want to round up now. Chinwe, let me come back to you. This is the final MPC meeting of the year. I guess, what's your outlook for the Nigerian economy as we head into a very crucial 2023 elections and all the like? How do you see things playing out for us?
Okay, well, let me just say that we are currently neck deep in the review stages of our forecast analysis, but I will share a few thoughts. So for next year, we still expect to see stable oil prices above $80 per barrel. However, domestic crude oil production will remain below pre-COVID levels. Of course, this is due to the existing challenges within that sector. Growth is expected to be underpinned mainly by the non-oil sector, We expect the services, agriculture, and to an extent manufacturing sectors to be the key growth drivers, supported by financial interventions. The effective implementation of the 2021 Finance Act and the Strategic Revenue Growth Initiative could contribute to the growth drive as well. Finally, we recall that the National Bureau of Statistics did announce that it's expected to embark on its GDP rebasing exercise in the coming year. And this would have an implication on growth figures. As for inflation, we still expect it to remain at double-digit levels. It is possible to see some moderation, largely on the back of positive base effects.
All right, thank you, Chinwe. Joshua, how do you see the economy in 2023? How do you think things are working out?
Well, I mean, just to go off what Chinwe said, I think we're going to see, or rather there's going to be a lot of focus on the oil sector simply due to the fact that we're going to be trying to ramp up production once again. How successful that is will have a pretty big determination on how well we're able to, increase our dollar inflows, which will have an impact on inflation to a certain extent. But as for the non-oil sector, I think that's going to keep chugging along. As for the banks, I think that we're still anticipating pretty strong growth, especially on the back of the fact that MPR is now 16.5%. Yeah. So yeah, the banks are going to do well off that. Financial services is going to do well off that, and also off the cash policy as well.
All right. Thank you for that, Joshua. Dami, how do you see the economy playing out? What's your outlook?
Well, I think economic growth is going to continue to hover around this 3%, 3.2%. We're going to see the impact of the tightening that has occurred this year and that would even continue to 2023. That's going to play also on economic growth. I think inflation is going to remain elevated. If and when forced subsidy, more about when, because it's no longer an if. When forced subsidies are removed, that is going to be a major factor that would weigh on inflation. And I think for the exchange rate, the CBN would have to address that in 2023. So those are my own thoughts.
Thank you. Philip, we'll round up and you get the last word.
Yes, I expect a tough economy next year. Typically, you find that the elections are going to be the major thing up to February. And then after that, then you then have a settling down. We have the government is still going to be in power till May 29th. So you wouldn't expect anything dramatically happening in the first, say, the first quarter, even entering the second quarter, But my major concern will be what global recession will be, how that will impact on Nigeria, and whether Nigeria will be prepared for what's going to come if that eventually happens. Because all the predictions are that a global recession is likely to come into place in 2023, and like everything, most things, we don't seem to be prepared, until it hits us. Yeah. And then you have the peculiarities with Nigeria, So if you ramp up oil production, if all the leakages are closed like they seem to be trying to do, then we expect to earn more foreign exchange. If we take advantage of what's going on, hopefully that Ukraine situation will continue. Yeah. Take advantage of that and then ramp up a reserve, because we haven't really built reserve much in the last 1 year, 2 years. So that's the challenges are going to be there. They're going to still be heavy. Hopefully, we just have to wait to see May 29th and see who comes in, and then we have the economic management team. We want to look at a finance minister that is up and about, and that is global in nature, not domestic finance minister. We want a global finance minister,
Philip Ishaka, publisher, Business AM. Joshua Odebisi, Sub-Saharan Banking Analyst with Vertiva Capital Management. Damilola Akimbami, Senior Manager, Clients and Industries, and Deloitte. And, of course, Chinwe Egwim, Chief Economist at Coronation Merchant Bank. Thank you, all four of you, our quartet, for taking us through the post-MPC decision, 16.5%. It's the Global Business Report. Do stay tuned. We'll be right back.